This could be the most obvious bull trap I've ever seen, while at the same time also having some promise to turn into a larger reversal. And while there have been some small improvements this week, there are still plenty of things that fall into the category of needing further improvement. So let's build a game plan that's based on logic to really navigate that dynamic. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of tonight's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY monthly time frame, now that the October bar has officially closed out, what do we see for candle structure and location? I'm certainly not going to argue that it's a bullish bar. We do have a decent sized upper and lower wick, and of course we did close red on the month, but notice the location of this bar. Obviously bar to bar count, lower high, as well as a lower low. But more importantly, remember that the monthly higher low thesis really revolves around this zone right here. If this is a monthly inverted head and shoulders neckline breakout, we know that we produced a higher high, and if we're going to pull back and find a higher low, this is the ideal retest right now. So this lower wick, although once again the candle structure is not totally bullish, is a good first step to at least identify that buyers are trying to step up at a logical location here on the monthly time frame chart. And hence, in the intro, why I said there's the possibility that this could turn into something larger. The monthly higher low thesis lives on as long as we're above this zone. And as of right now, the lows of the October bar are looking fairly good. Let's take a look at the weekly time frame chart, because this is where it starts to fall apart just a little bit, right? If we're really paying attention to trend, we know that the trend is still down with continuation of lower highs as well as lower lows. And it's very likely that we have the opportunity here to close for some sort of lower high on this week's bar. To neutralize the weekly trend, we know that we have to trade for an equal high, or we need to look for a little bit of continuation, some sort of pullback to produce a higher low, and then the trend is neutral as well. Obviously, this situation, the higher low, cannot happen over the span of one individual week, so it's very unlikely that the weekly trend reverses into Friday. So again, bears are in control on this particular time frame. We're looking for a lower high, and the ideal place for a lower high on the weekly is really a retest of the prior lows in here. And we'll remember that level as roughly 420.50, which we're actually trading above as of right now. But again, the illustration still stands that the weekly trend is still down. So I want to be very clear about the push and pull between the higher time frames. Let's move on down to the daily time frame chart and assess what's going on with the trend here and really evaluate what we could potentially see into the end of this week. When we look at it from this point of view, obviously this is the downtrend with highs, soft lower highs. Remember that we never actually flipped into an hourly uptrend here to set the soft lower high up against 425. So it's not really all that strong of a level yet in terms of the retest, but it is there. It's a soft lower high. But more importantly, along the way, we know that we have lows, lower lows, and we broke two major lower lows into the end of last week. So once again, as we drill down through the time frames, although the monthly is starting to show some signs of finding support off of the higher low zone, we're still in a weekly downtrend, and we're still very much so in a daily downtrend. Now, this counter trend rally, which is exactly what it is, it's a counter trend rally, wants to search for a lower high if the bears are going to remain in control. And the ideal place for that lower high was, as we talked about on Saturday, up against 420.50. The breakdown point from here, right? The other thing is that it's the upper edge of this week's expected move. Notice that we're slightly extended through that. We're also coming into a back test of our daily 200 SMA. So once again, I'm not really convinced that the buyers have proven anything more than we've seen a counter trend move. It's kind of funny how the narrative suddenly has shifted from, okay, Armageddon style sell-off, the market's going to zero, to guess what? It's the new bull market, right? Not so fast. There's still an opportunity here for a daily lower high. The last thing I want to point out before we move on down to the hourly, or at least talk about trend sequencing, is if we come in from here to here, notice that your 38.2, which would have kept this for ideal bear flag consolidation, did not provide any rejections with that confluence of the prior lows and also the upper edge of this week's expected move. Really, the rally through FOMC, even Jerome Powell's press conference, was fairly impressive, but it wasn't enough to change the trend. That's the main point of what we're talking about here on the daily. In terms of what we want to see, if you're a buyer, you want to see, obviously, straight up continuation. That really starts to edge closer to weekly trend neutralization, trading up towards 348s, roughly. Obviously, a bit of a stretch considering how far we are extended through the upper edge of this week's expected move. I would really assign lower probabilities to something like that. The trend could improve if we continue to trade into the soft lower high here at 425 and at least produce an equal high at 425. So a little bit of continuation starts to feel a little bit better from the buyer's perspective, and then we really want to watch for a higher low, right? On the daily time frame chart, a higher low needs to be found up against 416.75. If a daily higher low is found here, that would be the beginning for a trend reversal on the daily time frame, and you could start to look at it through the lens of some sort of inverted head and shoulders like this, with the neckline being somewhere around 425. Much better improvement on the buy side of the market will happen up and over 425, and that would really start to confirm, or at least make me more of a believer in the monthly higher low thesis. But as we know, the trends are currently down. So what do the bears want to see? The bears basically want to see a rejection of the daily 200 SMA. We want to see an hourly trend reversal, and then we'll trade back down towards the lows, because technically speaking, the hourly trend is up. Let's take a look at the hourly time frame now. Obviously, we can see that we have lows, higher lows, higher lows, higher lows, and along the way, of course, highs, higher highs, higher highs, and we just made a brand new hourly higher high. So you need to flip the hourly trend down with a loss of this potential area right here, 416.75. Let's say that we get a pullback. It does not hold, lower high breakdown. This starts to feel like a lower high double top. You're underneath the neckline. We trade back down to the equal lows. That's the bearish situation. That's the hourly trend reversal. That ends the counter trend move on the daily time frame chart. That's a rejection of your daily 200 SMA. That's keeping price underneath that major improvement level, which is 425 that we were just talking about, right? Pretty straightforward price action that we've seen this week, with Monday opening inside of the upper distribution from the Friday range. So we open in range, break into the close. Tuesday puts in consolidation underneath this pivot from the Thursday session. We break it into the close, and then we just see continuation into the FOMC move. So nothing really in depth to read into here from a psychological perspective. Fairly straightforward. Again, counter trend move. In terms of what we have going on, you can see that this, as an hourly reversal, really kicked off as we broke up and over 416.75, which is why on the retest, that needs to be your next hourly higher low if the counter trend is going to continue, right? If we're going to continue to see a move in the upward direction, you need a higher low here for either a daily higher low or an hourly higher low. Either of them will suffice at 416.75. Why else is 416.75 important? Let's take out the fibs, of course, from the bottom up to the top of the move. And what you'll notice is that your 38.2 is technically above that level. So ideal bull flag consolidation is technically up here. We have a little bit of wiggle room with structure. It's looking pretty good if buyers can keep things over 416.75. So the name of the game is 416.75 and 425. If we're trading in between the two, I think you're kind of in that no man's land still, where the daily is trying to make an attempt higher, but the weekly is still pressuring lower. The hourly trend is trying to hang out here for some higher consolidation, but certainly, a slip underneath starts to become a little bit more dangerous, right? Let's take one look at our anchored VWAPs intraday as well. And what you'll notice is that we've broken over all of them from all the main inflection points. So top, this is your prior Jerome Powell. It wasn't really a press conference, but a speaking engagement, right? This is the low of this move. This is the low of the overall move. And what you'll notice is that you do get confluence at that 416.75. So I think it's, again, very straightforward what the buyers need to see into the end of this week. Any pullbacks need to hold over 416.75. If you're a seller and you're a believer that this is truly just going to be an hourly counter trend, it is a daily lower high that's trying to be set, you're just looking for the breakdown underneath 416.75, and then you're trading back down to the equal lows, which are much closer to 409.75. And then remember, this has not gone anywhere. We do technically have a gap underneath us to close under 408.65 closes at 407.20. That's what I've got for you. Let's take a look at some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Overall, we do see a small bullish edge to our internals, but it begs the question, is this the beginning of a stronger reversal in the upward direction? And I would argue not really. The internals are more so aligned with this still being a counter trend move. The reason I would say that is no individual day breaches positive 300 million here from a volume flows perspective. Only Monday opens in trend higher zone and quickly fades out of it. From there, we're definitely positive so far this week, but we're not in trend higher zone. We're not really seeing exchange-wide participation where it's buy everything, right? Insert the Kramer meme or something like that. In terms of the cumulative tick as well, very mild build on Monday. Tuesday, flat into the close, maybe a little bit of lift there. Same thing on today's session with the FOMC, but what do we classically use as a distinguishing point? It's 5,000. it could be positive, could be negative, but 5,000 is the typical read that we want to say, yes, this is a substantial day. And we're closing at like 2,600 on today's session. So not all the way there yet from a new money buyers entering the market perspective, but it is a respectable counter trend, which is why that 416 higher low is something of interest. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Overall, you can see this week that the value area and point of control has migrated lower from the Friday low. Here's Monday. Here's Tuesday, of course, and here is today's session, Wednesday. The point of control has also continued to migrate in the upward direction here, here, as well as here. The only interesting thing to note is that we do technically have a poor low from the Tuesday session, and the poor high was repaired, right? That's today's low of day that repairs that. But on today's session individually, the value area was lower in the session, as was the point of control. Technically, we have a double distribution with the upper distribution here, L and M period, and the rest of the day is down here. It's really that afternoon break, which is separated by a small string of single prints. That is going to be up and over 42.49.50, and the closure of the singles are at 53.25, 42.53.25. So that's the double distribution from today's session. If on tomorrow morning's open, we open in the upper distribution, that is a more bullish indication, obviously. If we open in a lower distribution, it's a failure of this end of day auction higher, and we should be expecting balance, if not lower, to potentially test that 416.75 level on the S&P. If I scrunch this way out, I want to remind you that we do have a couple of VPOCs up above us. That would stand for Virgin Point of Control, just a point of control that has not yet been tested. There's one. Here's 2, which has not technically been tested in that upper area, and this also is 3, just shy in that upper brick. Technically, if I were to zoom in on this, you can see that we missed the VPOC by just a hair there in this particular interaction. So overall, 3 VPOCs remain overhead, and I also want to point out, if this does see continuation, the next major break, this is the equivalent of 425, is up and over 42.80, right? 42.80 is a mechanical high because we have equal high, and this goes right to the value area high of that individual session that preceded, right? So boom, there's your mechanical level. In terms of your 416.75 pullback, let's go ahead and bring that one up. It's going to be close to your low of day from today's session over here in the ES. I would be more so inclined to use the zone right around 4,200. 4,200, as long as we can resolve that in the upward direction, looking a little bit better on the buy side of the market, or at least for neutral-ish consolidation. If we lose 4,200, starting to trade back down towards the equal low. Let's shift gears over to the Nasdaq QQQ monthly time frame chart and do a quick little compare and contrast. Obviously, the October bar has closed out, and it's much more so an inverted hammer over here in the Nasdaq as compared to our S&P 500. Don't get me wrong, we do still have a little bit of a lower wick, but the upper wick is far more substantial. And what you'll notice as well is we're not even close to the monthly higher low retest zone, which is at 320. That's the level that we've been talking about. Obviously, this wick is kind of in no man's land in the thin structure from the AI Mania breakout. So from that perspective, the October close is really not as good looking as the S&P. We could take a look at the weekly time frame chart just to reiterate that yes, we are technically in a weekly downtrend here in the Nasdaq with highs, lower highs, lower highs, lows, lower lows, and lower lows. The really important note here though is that remember we were sort of giving the Nasdaq the benefit of the doubt on the first breakdown over here, right? It was turning into a look below and fail. We've finally closed a strong weekly bar underneath, and look at where we're currently trading. Now there's nothing saying that into the end of this week we can't get a mild little pullback here, produce an upper wick on the weekly chart, and then that would look much more so like an inverted hammer upper wick rejecting the back test of the upper range. But given the current trade price, and a lot of this is going to hinge on Apple earnings, but given the current look in front of us, if we were to get a closure inside of the upper range, I would have to think again, is this turning into yet again another look below and fail? It's a reasonable thing to be thinking about on a closure back up and over that particular level. Let's take a look at the daily time frame chart, continue to get granular here and walk on down through the time frames. Many of the same sentiments apply as to what we just discussed in the ES and the S&P 500. An overall downtrend is in place. We have highs, soft lower highs, never flipping into an hourly uptrend here. So we're still looking for a lower high to be set. We have lows, lower lows, and lower lows into the end of last week. This is still a counter trend move until proven otherwise. One thing to point out here is that there's really no struggle recapturing the bottom end of that weekly range we were just talking about at 352. So it leads me to believe, again, if there is a pullback into the end of this week, let's say that we completely wipe out today's strong close up at the ties, right? If we get here on Thursday and then just kind of bounce around on Friday to stay neutral towards the upper edge of this week's expected move, technically that can still result in a weekly close above that 352. So keeping an open mind to how that resolves into Friday's session. If we do close underneath, it's a stronger indication of a weekly rejection. A lower high has been set. We'll look for continuation in the downward direction. What else is going on here? If we take out the fibs, again, no struggle at the 352, no struggle at this particular level right here, which is also the upper edge of this week's expected move. We'll see that on the hourly charts in just a moment with a little bit more clarity. But if I go in from the high of this to the low of this leg, right, this entire move here, 38.2 did not reject for bearish consolidation underneath. Very similar sentiment to what we just discussed once again over in the S&P. We could also come from like the balance, and we'll see this on the hourly as well. If we do the same idea, your 38.2 just gets a little bit closer to that 352. So no matter how you slice the cake here, the price action itself quite literally sliced in the upward direction in favor of a bullish counter trend move. Now, if the trend is going to change, right, things will mostly improve if we can produce an equal high around this 359.50 soft set of higher lows, equal highs from here to here, equal highs, get it together. That would improve things here. It would also leave the door open to a potential higher low than over 352, right? And that starts to give you that same inverted head and shoulders that we just discussed over on the S&P. So that's the path of improvement if the buyers are going to remain in control. If the sellers are going to start to really build an edge here, we need to see a failure back down underneath 352. So let's take a look at the hourly time frame chart and just start to assess how that might potentially unfold. So clearly we can see that we are in an uptrend, right? We have lows, higher lows, higher lows. It's the same old song and dance. Fire up some Aerosmith on a beautiful Wednesday night, right? So higher high. We just produced a brand new higher high. The buyers are in control here. If we do get a pullback, once again, 352 is the most optimal pullback because it technically keeps us above this breakout point right here, which is 350. So what that means is, technically speaking, we can still find a higher low over 350, but at least that complicates the issue for the buyers getting back down underneath 350 to the weekly level of importance, right? So this juncture in the market continues to be extremely dangerous, and that's what I've been warning about over the past week and a half, right? Is that this monthly higher low thing is not going to be easy to resolve. Lots of people are going to get hurt, and I think it boils down to understanding that this felt really bearish. Now we're seeing this extreme move in the upward direction. Are people going to get trapped on the buy side? Is it going to roll back over? Are we going to get a weekly lower high? I mean, there's all of these different things to navigate when all three of the major higher time frames, monthly, weekly, daily, are in conflict with one another, basically. So 350, enough sort of describing aside. With that in play, what else can we see? Let's take out the fibs from the bottom up to the top, and where's our 38.2? Lo and behold, 352, right? So what does that do? It keeps us in line for bull flag consolidation. It also keeps us above the weekly level. So 352 is a really important zone for that particular reason. The next thing we could do, of course, is throw on our anchored VWAP set. And there's two things to point out. This is coming from the Friday low, and what you'll notice is it's still roughly around this area. If I go ahead and back it off just a little bit, let's go back a day, and let's change this to 1230. There we go. And we'll try that out. That's the low of the move, right? This is slowly going to start creeping up as well. This builds the case for 350 being the major line in the sand. Technically, the hourly trend can produce a higher low pullback trading into this breakout point, right? The price action here is very straightforward. There's really no need for an explainer. We, again, open in the upper distribution from Friday on Monday's session. We get this balance that forms break into the close on Tuesday. This morning, we open on a gap up and rally, right? So gap and go, very straightforward. Buyers are in control. We're squeezing out some of the shorts who are entering down here with absolutely horrific trade location. So the name of the game is potential higher low pullbacks around this zone. It's about a 2-point zone, 352 to 350. If we can hold on to it, great. The counter trend lives on. And also we close a weekly bar back up and over 352. If we fail this zone and close underneath, that's where we're trading back down to the equal lows. And as we just talked about on the weekly time frame chart, this does not look nearly as good as the S&P. Lower targets here bring you through the AI Mania breakout to get a retest of 340.50, and then there's a gap to close around your weekly 50 SMA underneath 336.50 closes at 332.50. So that's the downside over here on the Qs if we get that hourly rejection and start trading towards the equal low, which would be here. Let's give you the number. That's going to be at 342.85, 342.85, 343. That would be the low that you're searching for underneath 350 here. Let's move along very quickly. Take a look at the internals. This is a little bit deceiving to me because it's not so clear in the Nasdaq that there's any sort of buy-side edge, right? If you take a look at what's going on from a volume flow perspective, sure, they're all positive, but they're not even close to positive 400 million. Net flows on the week, they're getting close to substantial, but it's just because we haven't had a flat or even down day. In terms of the advanced decline line, over the span of the week, it's technically moving lower. And if you look at the cumulative tick, look at what happened today. Look at the price action on the right here, right? Very clear break in the upward direction. Cumulative tick actually closed out negative. So it begs the question, do you really want to be a believer in this counter trend move when the internals, literally the exchange level data, is not supporting the move in the upward direction? I don't know about you, but it does not give me a warm and fuzzy feeling inside about a strong bull case to be made. If we look at the market profile of the Nasdaq, what you'll see is a similar string of single prints here, separating an upper and lower distribution. Value area and point of control were in the lower distribution, slightly more bearish than bullish, right? If we find ourselves trading in the lower distribution, which is sub 14,675. If we're underneath that in the Nasdaq, that would, to me, indicate a little bit of a failed breakout into the close here. If we're trading in the upper distribution, we'll continue to monitor for the counter trend continuation. The big retest level out of your Nasdaq is here, closer to 14.5. That would be the top and top of the 2-day balance from this area. And we also still have some VPOCs, virgin points of controls, above us here in the Nasdaq. A target would potentially be the first one. That's going to be way up here at 15,050. Right? Remember that from the stream, 15,050. That would be the first one. And you do have a mechanical level here, which is, that number is going to be at 14,865, 14,865, 14,870. If you start trading around that level, expect this, because it's so mechanical, to potentially break in the upward direction. Last but not least, the IWM monthly time frame chart, everybody's least favorite broad market index. However, it's acted as the canary in the coal mine. In terms of the October bar, not even close to a lower wick, not even close to an upper wick, just pure domination from the sellers, extremely weak close. The one thing I would say here is find any other segment of IWM price action where we have 3 aggressive monthly bars to the downside. The only place I can see is back up here when this whole topping process was underway. Before you get a counter trend move, there isn't one, right? 3 over here, a little bit of an uptick, right? So just keeping in mind that it's very possible, as the IWM kind of comes into the bottom of this as a horizontal perspective, a little bit oversold, it wouldn't be unreasonable to see a small counter trend move unfold, or even just a pause. So expecting straight up continuation, like Armageddon, monthly 200 SMA at 120, a bit aggressive. I would say manage expectations here. Now it does, of course, as we know, become extremely dangerous underneath this low, because there's a massive chasm below in terms of structural support. I mean, the first place that we want to be thinking about is maybe north of 140, and then there's really nothing going on over here, right? So it is a dangerous location, but just maybe think twice about being aggressive at the very bottom of the range without any confirmations first. So if you're like, okay, so where's the sell really step in? It's 2 places. If you get a lower high and then reattempt in short proximity of time, that's your entry for lower on the second go around after the clear lower high. Or if we break first, obviously a lower high underneath gets you to the same retest, and your risk reward is far more favorable. So understand that on the IWM monthly. If we take a look at the weekly time frame chart, again, not much to really write home about over here. Inside bar forming thus far, there's really not even a reattempt to get back up to here on the counter trend move that started to unfold, and we can also see that on the daily time frame chart. As we throw the levels back on, that retest is much closer to 169. So we're starting to get a little bit of lift, but really nothing to the degree where we would say, oh wow, there's a chance that the daily trend might reverse. Just not even close. Not even close, as long as we're underneath 169. I would start to make you aware of, and I should encourage you to start thinking about, okay, a rounded bottom could produce that counter trend. And if we take a look at the hourly time frame chart, right, and have a look through this lens, I mean, it's our favorite pattern. Mr. Regan's probably going nuts here, but it's the inverted head and shoulders, right? And if we start to spend more time over that neckline, 165, the opportunity is for not only the top of this prior 2-day balance, but of course, the larger retest we were just talking about at 169. So don't get it twisted. The IWM and small caps are not coming for this massive reversal. Maybe it could turn into that, but there's no indication of that whatsoever as of right now. If we do start to take out the bottom of this right shoulder, if we start trading underneath 163.50, I think it's time to just kiss this thing goodbye, because clearly there's no traction in the upward direction. Today's daily bar technically closes over this area of inflection. If that completely fails, we rotate back to the bottom and break 163.50, Buyers, you had your chance, you kind of fumbled it, so to speak, and it's not looking good. I would be expecting lower prices, probably back down to the lows of last week, around 161.80 as of right now. If we take a look at the internals for the Russell side of the market, again, it's more so similar to the Nasdaq, where the advanced decline line continues to trend lower. We actually did have negative breaths on today's session for a duration of the day. Earlier in the week, again, there's no indication whatsoever that we're up around substantial reads. The cumulative tick speaks for itself. Mild upside on Monday, flat on Tuesday, negative on today's session as we're starting to break that inverted head and shoulders neckline. Really doesn't speak to a high degree of confidence as we walk forward here on the buy side of the market. Last but not least, for the small caps is, of course, our market profile. And what I want to illustrate here is that the value area is technically progressing in the upward direction. I'll just start to highlight these things. And of course, this would be the low of last week. So value area is marching in the upward direction, and if we can take this out, it would be a decent indication that, okay, maybe we want to trust the counter trend breakout for a short duration move in the upward direction, right? And by short duration, I'm speaking about time span, right? I'm not talking about shorting small caps as they're breaking out up and over that neckline. The target here out of the Russell in terms of futures would be up around 1700, and the breakout point right around where we're trading currently actually is close to 1675. 1675 is that break point. The longer that we spend above, the more likely it is that we can see that rotation into 1700. Let's take a look behind the curtain at the weekly performance of our sectors, and what we'll notice is that the XLK, the tech sector, the heaviest weight risk-on style sector, actually led the way through the duration of this counter trend move, up a whopping 3.22%, which I'm sure is catching a lot of people off guard from the sell-off that we saw over the last week and a half or so. And again, it just reinforces the idea of why I was saying don't be short in the hole during this rotation. So underneath it, we see the XLC, also a risk-on style sector, up 3.19%, followed by financials, also another risk-on style sector. Utilities are D for defensive, and they're also up substantially, up 2.36%. So we're not out of the woods from that perspective. One thing that I do want to share with you is if we just sort by today's performance and you look at what led the pack today, because today's really where we made the most progress in the upward direction from the gap and go, the tech sector still leads, up 1.75%, followed by communications, and then utilities is up a flat 1%. So it's not like we're seeing a full-blown flight to safety style move into utilities leading this market higher. This is one of those subtle improvements that starts to make me feel somewhat okay about being open to a higher low here and changing the daily trend. Let's take a look at the XLK chart itself and see what's going on here. Notice the strong recapture of this level at 163.50. This was looking pretty nasty, technically producing a lower low, and I was thinking that there was an opportunity for a lower high up against that level. Clearly, that was not the case. And with the strong close over 166.50 even, we've taken out this last potential area. And this would be the soft lower high that we discussed over on the QQQ, right? So because of that, the XLK is actually somewhat close to having an opportunity to change the trend. Because we have this as a higher high, all we need is a higher low over 163.50 now, and you could start to become slightly more constructive on the XLK. Now, let's not get it twisted again on a weekly time frame chart, high, lower, high, lower, high, still an opportunity for a lower high up against that daily 50 SMA, but still giving this one a little bit of a benefit of the doubt here, getting that double break, so to speak, over 163.50 as well as 166.50. Really watching the tech sector very closely through this next couple of days, even weeks, to see how this 163.50 resolves. As long as we're above that, again, I think you have to give a little bit of a benefit of the doubt here. Apple earnings will be huge on Thursday after the close. Let's take a look at the communications sector, because this as well is starting to look more so like look below and fail. Look at the sort of momentum back up into this range, not rejecting here on the retest of the bottom of this balance for a lower high, clearing 65. Again, don't get me wrong. Is there an opportunity for a lower high? There is, but there's also still a very strong opportunity for a higher low now up and over the bottom of the overall range here at 64.25. So keeping a very close eye on that particular level. XLU utilities, again, up towards the top of the list, but do we see any substantial breaks here, especially in relationship to what we just saw out of tech and communications? Not really. We did technically take out the top of this zone, but remember we have the opportunity for a weekly or even monthly. At this point, lower high underneath 61.40. So I'm not all that concerned about this being a flight to safety style move just yet. As long as the XLK is at the top of the pack, It's not really the biggest concern. Let's take a look at the XLY. What's going on with consumer discretionary? Clearing this, but still a clear opportunity for a lower high up against our daily 200 SMA, the green moving average on your screen. Could this kick off into a counter trend daily up and over this kind of as an inverted head and shoulders neckline? It's possible, but I'm not nearly as constructive on the XLY discretionary as compared to something like the XLK. Hopefully you can clearly see the difference, right? They're not even close. Next up, the XLF. What's going on with financials? Strong move this week on the heels of JP Morgan, Mr. Demon, saying that he's going to unload some shares, right? And we even took out the top of that bear flag. So as of right now, this, of course, is a higher high, looking for a higher low, and then the trend starts to attempt a reversal here on the daily. Don't forget that the strongest inflection point on this chart is really this zone. We're quite a ways off of it at 33.65, so there's a lot of work that needs to be done here, but it's a first step. It's a step in the right direction. If we can stay over 32.35, a little bit more constructive. If we start falling underneath, then it loses its shimmer, loses its shine, right? More so, again, impressed with the XLK at this point in time. Real estate, extremely rate sensitive, little bit of a move lower in rates today, very, very mild, and a small uptick here, not really making any substantial strides. Lightweight sector moving on. XLV, D for defensive, but as we know, it's the second heaviest weighted sector by market cap. So breaking to this very substantial lower low, that was an issue we talked about on the Saturday update. The fact that we're rallying now doesn't really save anything. There's a strong opportunity for a lower high up against 126.25. But what does this mean from a posture perspective? It does not look like a flight to safety rotation in the healthcare sector, which actually stacks up, as we know, as a bullish data point. Let's carry that forward and talk about the XLI. Again, lower high opportunity here. This is do or die tomorrow at 98.75 basically. It's 8% of the S&P, so it's meaningful, but not really going to have much of a difference as long as the XLK continues to be at the top there. Materials, same concept as discretionary really, with the opportunity for a lower high up against 76.85, so still a concern in that one. Energy really got beat up. You get that full 100% retracement. Remember that you never want to be short in the hole on the lows of this move. We're starting to get consolidation. Now that we have that consolidation, now that we've gotten a couple of days of reprieve, now you're looking for the equal low reattempts to open that door through 84.50. That would be a small headwind for the markets. Next up, we have the XLP. What's going on with consumer staples? D for defensives have gone absolutely nowhere. Really no concerns about this chart. If it does break out, remember that it is D for defensive, but upward pressure is going to be upward pressure. As long as it's not at the top of this list, which clearly it's not even close, right? It has the potential to break, help the market, but not also signal some sort of flight to safety style move. If we take a look at the ratio grid, if you're not familiar with the screen, by the way, check out the tutorial in the top right-hand corner. What do we see here? I would say that we're starting to neutralize a little bit more than just being purely risk off. And the main reason for that is the move higher here out of the tech ratio, as well as the move lower here in the healthcare ratio. We just kind of talked about that dynamic, right? XLF needs to improve. It needs to get away from that 50 SMA. XLY is still an issue. And again, we saw that on the structural chart, so this should not really be much of a surprise. So again, bordering on neutral from a risk posture perspective, not full-blown risk on, but it's also not as bad as it was when this was more so sideways, and then this was also getting beat up when this was still elevated, right? When the financial sector was down here, that was a little bit more of a concern, where we were like, yeah, risk off is the primary thesis. Notice that the XLP is rolling over slightly, as is the XLU. It's going sideways instead of presenting this clear outperformance from this section right there. Let's take a look at some specialized ratios and see what else these can tell us about the market. This is the XLK over the SHY. So we're talking about basically risk-free rate of return versus the most risk-on style asset tech. And you can see that it's basically in line with the market down here. I will say that the lower low is not nearly as aggressive as the S&P, and that would be more so reflected in something like your Qs. But the next big divergence to pay attention to here is, does this create an equal high? If this creates an equal high, it would be a pretty darn good indication that you're looking for a higher low out of the S&P equities down below, and it would start to feel like a stronger reversal here. This would just illustrate a preference for the tech sector versus the short end of the bond curve, right? Next up, let's take a look at the XLK over the XLU for a little bit more of a classic. If we could get that to work. There we go. Did it load up? No, it's not loading up. What's going on here with Think or Swim? Let's try a different one. There we go. A little bit of a glitch in the matrix, it seems. Anyhow, there we go. Let's try the XLY over the XLP. This is clearly giving an indication that we have the opportunity for a lower high after breaking to a lower low from this range. That would classically signal a little bit more so of a risk-off posture for the market. And once again, I think that the combination of the two things that we've just looked at, let's try the XLK over XLU one more time. There it is. This all in combination would sort of tell us that the risk appetite for the market right now is a little bit more so neutral as opposed to full-blown risk off, right? Let's take a look through the dollar and see what's going on from a dollar perspective. Dollar's consolidating up and over the top of the monthly range from over here. It's not really a headwind until it starts breaking out further again, and today actually was a down day with the FOMC and rates. What we can take a look at here is actually what's going on with gold, and this is somewhat interesting because gold has started to pull back and the dollar did not break in the upward direction. So it begs the question, is it possible that gold could consolidate here more so for a bull flag, continue to break out, and that would put downward pressure on the dollar? If the dollar starts moving lower, we know that equities can typically start to move higher with a little bit more ease. So watching that very closely, considering how, again, gold has pulled back, but the dollar really didn't make an attempt to break out of its major range. Let's have a look at interest rates, speaking of Jerome Powell and everything that's going on there. So here's the TNX 10-year yield, and from a technical perspective, very much so still in an overall uptrend, finding potentially a set of higher lows here after making a higher high. So it's not worth writing this off and saying, oh, that's it, that's the nail in the coffin for rates, we've topped out. Jerome Powell has been pretty clear that we're not going to raise one more time. He's kind of foggy about that, but if that's your belief, then look at this from a technical perspective and try to tell me that it's not still in an uptrend. I wouldn't really believe you. So I still think that 5.3 as a 10-year can be around the corner. It really comes down to, can we break out firmly up and over 5%? Let's have a look at the inverted ZT to get a sense for how the bond market's feeling about Jerome Powell. And as of right now, it's sort of signaling exactly what he signaled in his meeting today in the press conference, that it's very likely we just see the prolonged pause. Let's take a look at the Fed tracker tool. So here is the tracker tool ahead of the FOMC and press conference from Jerome Powell. Clearly, higher for longer is the path. The prolonged pause is on the table. And here it is after the FOMC announcement, as well as the entire press conference from Jerome Powell. What did we learn from Powell? The answer is absolutely nothing. The market will continue to have higher for longer, whether you like it or not. And his basic justification for that is that the data continues to come in just fine. Really, the main thing he emphasized is that the labor market is a priority. And as of right now, it's really not showing any signs of breaking to a degree where they would need to intervene with rate cuts to start to stimulate economic activity, right? The unemployment rate, the true month-over-month reading, will be incredibly important to understand on the Friday morning open at 8:30. Come join us up in the penthouse for complimentary coffee and donuts. What is more important for the market today, which I had to do some research on because I am not an expert in everything, regardless of what you might believe, is actually the QRA, a term that threw me off at first, but it's the quarterly refunding allocation from the Treasury. Basically, how much in terms of long-term debt are they going to put on the market? And this was really the focus of today because what happened is that there was actually less issuance than what was expected. And if you think about this from a supply and demand perspective, here's supply, here's demand. If they're going to supply less and demand remains stable, let's say, then prices have to move up. And what does that mean for the TLT? It means it bottoms out, and it means that rates, in theory, start to come down. And that, of course, would be a bullish indication for the market. This may have been one of the reasons as to why in the pre-market, around 8:30, we started to see some lift in the upward direction. In terms of what's on tap from an earnings perspective, let's take a look at the calendar. We know that after the close today, it was really the bottom tier tech companies. Palantir, I mean, give me a break. A cup of coffee from Starbucks has more market cap than Palantir. It's all about Apple. After the close on Thursday, we'll be keeping a very close eye on that one into the end of this week, specifically with its impact on the XLK. Let's get back on over to the platform and assess the risk appetite for our market. Notice that the TLT ratio to the S&P is still underneath its descending resistance trendline. So is the flight to safety trade trying to unfold? It's possible that this could happen if the equities market starts to roll over for a lower high and the TLT remains sideways or even starts to get a little bit of lift based on what we just read from the QRA. So this is still a very, very close watch as we progress here, as we start to navigate for the monthly potential higher low, right? Next up, let's take a look at bonds in relationship to themselves. This is one of the categories that improved slightly, but still really needs to continue to show more improvement. So a little bit of a move lower, a little bit of a move lower, a little bit of a move lower, but overall, I mean, let's not fool ourselves. We're still at the highs mostly of these overall moves in the upward direction. So still needs some more improvement. These things need to fade in the downward direction if we're going to be more confident in the appetite for risk for equities down below. Let's take a look at credit spreads, which also speaks directly to kind of the bond market, if you will. Taking a look here, again, subtle shifts of improvement, specifically on the shorter end of the credit spread journey, or if you will, right? And what you'll notice is that we already have a lower high, and this is starting to break to a lower low. So if this downtrend can maintain itself, and we can come into this 109, I would certainly start to feel a little bit more confident about the risk appetite for equities down below. We know that the medium to longer term credit spread really hasn't been impacted all that much, which once again might lead me to believe that the monthly higher low thesis lives on here. It definitely lives on, but this would give a little bit more confidence to the higher time frame perspective. Let's take a look at the HYG in isolation, because a lot of people sort of were talking poorly about the HYG in the comments section the otgy day. Remember that the HYG bottomed first and then it started to make higher lows? It was just a matter of time, right? It was just a matter of time. Your bullish divergence did play out. It has not fooled us. It has not fooled us once. This has been a pretty decent indication to be paying attention to. And once again, one of the reasons why I was an advocate for being cautious about new money shorts into the lows. There you go. That is exactly why. Let's take a look at Bitcoin and see what's going on from the digital gold perspective. Continuing the breakout in the upward direction. This certainly helps build the case for more of a risk-on appetite for the market. Let's move on over into some breadth indications. What do we see out of new highs versus lows? Big, sharp improvement in the upward direction. It looks really, really great signs of recovery, but let's not be fooled. It's still underneath the zero line. It's very, very difficult to have a bullish market if we're negative on new highs versus lows. Again, just think about it logically. You're making more new lows than you are new highs. Can't really have a bullish market under those circumstances. This falls into the category of needing improvement. Let's take a look at the SPX A200R. This is starting to find a counter trend move off of these extreme lows, but it's still sub 50%. I would just point out that we didn't make it all the way to what is typically required for a massive oversold style bounce, which is closer to 20%. Doesn't mean we have to get there, but it keeps an open mind for another leg lower in the market. Next up, let's take a look at the SPX A50R. This is one of the bullish divergences we've been pointing out as well. Higher low is on the table, whereas the S&P obviously continued to produce that lower low. So overall, this speaks to the monthly higher low thesis remaining on the table as a possible situation. You really want to get over 33%, 1/3 of companies in the S&P over their respective 50 SMA. Next up, RSP. What's going on with the RSP? What you'll notice over here is that we are attempting to recapture the 135.80, but we're not all the way there yet. If we put in a lower high at or even just around this area, and remember, there's a lot of room here for a lower high, trading to the equal low is extremely dangerous, because if we open this chart up to, like, let's just say 2 years, the October low is the next major support. There's not a whole lot in here preventing you from rotating to the lows. There might be something around this 130, but again, that is a big headwind for the market as a whole. It's really not a helpful look. QQQE for the equal weight Nasdaq. Again, room here for a lower high, potentially keeping us bearish and not really all that constructive yet. You would want to see improvements and this flipping into an uptrend for that to be the case. I'm also just realizing that we did not look at the SMH, so we'll do that now. Here's semis. In terms of the ETF, it continued to break down a little bit here, but this rally keeps us underneath the retest level at 143.40. So this also stacks up as a smaller bearish data point for the Nasdaq, again threatening the thin structure in the QQQ weighted underneath through this equivalent zone, if you will. This should have been included with the sectors, right? Next up, let's move along and take a look at the Dow. What's going on from a Dow theory perspective? So transport's starting to bounce off the bottom end of the range, and this also back over the equal high, or I should say the equivalent. It's making a higher high over the equivalent low that the breakdown came from, right? And that's not the case in transport. So this is saying not yet. We're not ready for a bottom yet over in equities as a whole. That is a headwind, of course. Let's take a look at volatility, because this is improving. It is making a stride in the downward direction. We never got that capitulation type spike up into the 30 handle. Remember, that's really what we need for the market to say, okay, it's like Armageddon, everybody's selling everything. Usually that does not last very long. Typically your spike is up towards 30 or the 40 handle in the VIX. If we look at the precursor to the VIX, which of course is the VVIX, this is actually making a really substantial breakdown of this trend line right here. So if the market is going to continue in the upward direction, you probably want to see lower highs underneath the trend line, or you could just use the precursor level of 103. As long as we're sub 103 in the VVIX now, feeling much, much better about a more constructive monthly higher low. Let's take a look at volatility futures for all of the purists, and this aligns beautifully with everything we've pointed out thus far. VIX futures moving into a deeper contango from being in backwardation up here near that zero line. Remember that this now means there's less risk in the present day than there is at some unknown point in the future. That is exactly what money managers want to see to start allocating capital to the market. So does this align with or sort of contradict the monthly higher low thesis? I would certainly say it aligns with. Kicking off our core list of companies is none other than Apple. They are reporting earnings after the close on tomorrow's session, so be mindful of your implied volatility if you're an options trader. If you're intent on trading this, and just full transparency, I have no intentions on trading Apple ahead of earnings. But if you are, the main idea here would be for a higher low that wants to stay above 170.50. That would also be a recapture of your daily 200 SMA. From there, we're sort of looking for some lift in the upward direction to maybe reverse the curse here. Again, earnings, we need to take this in stride. It's very likely that Apple will have some sort of major gap into Friday's morning session. If the bears are going to take control, you really want to see price back down underneath 170.50 because that would start to confirm a failed break of the 2-day range and a loss once again of your daily 200 SMA. Let's move along and talk about Microsoft. You can clearly see the 100% retracement has been made. So not only did we get a gap up from earnings, we faded the entire gap, and then we've retraced all the way back up towards the gap location in the first place. So talk about a lot of round trips in there. Regardless, higher lows want to be found over 340 for some sort of very sloppy here cup and handle. You could probably see it here on our hourly time frame chart. There you go. There's your cup and handle. If we get consolidation or any sort of higher low around that 340 zone, technically your line in the sand is 339. In terms of just bullish continuation, any consolidation up here that breaks higher tomorrow morning is looking at 351 as a potential target. Lower highs underneath 340. I would not become bearish there, and I would be more neutral in this range and more so willing to trade the downside underneath 334.65 to travel back down to the double bottom lows at 328.25. Next up, GOOGL. Let's take it back to a daily time frame chart just to understand where we're at from an earnings gap perspective. Still underneath, obviously, that area, but we are moving in the upward direction, breaking out from a 2-day balance range. Let's take a look back at the hourly time frame. If this is going to start to indicate some sort of, remember that this upper wick is actually true. On Google, that upper wick is true on the early stages of the Monday session. If this is going to act as some sort of like inverted head and shoulders, you basically want to stay over that neckline at 125, right? Very shallow right shoulder there. But if you can hold up over that right shoulder, if you can hold up over 125, even if you're not fond of calling it by pattern, whatever, price acceptance over 125, I would continue to look for consolidation. Break over this level starts to continue to put pressure on shorts. Starts to continue. It continues to put pressure on shorts up and over 126.75, the bearish consolidation from the earnings gap down in the first place. Obviously, your gap closes up and over 128.35. You have some intermediate levels in here, but the main gap closes 137.50. Downside, just like what we had in Microsoft, really only wants to step in under 123 for a failure of this area to hold as support. Next up, Amazon. What's going on with Nancy? It's no longer at the end of the list. We can't say last but not least the mini beast, but what we can say is that there's a pretty impressive bullish display of price action here. Here it is on the daily time frame chart. Remember that we got this big move lower, earnings gap up, kicked it back into the range, and now we've broken out over this as a even daily or weekly double bottom neckline. So now the name of the game is any higher low over 131.75 is kind of good to go from that perspective. We started to get that indication on the Tuesday session in that lower wick, right? Holding the 50 SMA as well. The ideal higher low at this point, if you're going to be the most bullish, would be a retracement of yesterday's range, catches a daily higher low here, break, and then you start walking up your targets 140.40, then 145.50 would be the high from in here. Downside, really, you need the lower high failure back down underneath that 131.75. Next up, NVIDIA. What's going on with NVIDIA? I've got to find the audio clip, but you can bet your bottom dollar we talked about this either on the stream or in the show at some point. We talked about everybody could see the head and shoulders, right? We talked about how it's not a fake out here. It's a fake out once you break it, sucker in all the shorts, and then start to rip back in the upward direction. That's the dynamic that unfolded on today's session. So going forward, you need to watch this level right here. Let's take it down to the hourly. Let's get very, very clear on what that level is. It's this right here at 412.25. We broke out firmly up and over it today. We even produced an intraday higher low above. As long as we're above that, the head and shoulders is not in force, and I would be thinking about these trapped shorts continuing to squeeze out. Your next major target overhead, 433.25. That's really the main watch out of NVIDIA. Here's the metaverse. What's going on with Zuckerberg's Fantasyland? It's still kind of trying to resolve the midpoint and this chop zone from in the past. A little bit less interested in this chart due to the volatility that's been displayed in here, I think that there are cleaner opportunities. I mean, even just look to NVIDIA, for example, right? So watching something like that, if I were going to give you some levels to at least be paying attention to, 307.50 is a big one. Higher lows above that remain constructive for a target here. 316.75, you can walk them up. If we start failing 307.50, I really would not be a player of the metaverse inside of this extremely proven choppy range. Next up, Tesla. What's going on with Mr. Musk's boring company drilling towards the center of the earth? A little bit of a counter trend is on the table. I really think you want to watch this 205. It's a big inflection point. It's also the lower trend channel, which I'll point out in just a second. But if we can clear that, you get an hourly sort of higher low double bottom, ascending trend, whatever you want to call it, up against 205, right? That is the name of the game. If you break that and higher low above, counter trend is on the table. This would be the primary target with the daily 200 SMA at 218.50. If this is going to fail, if we break that trend line, then this sort of starts to feel like a double top here underneath the neckline, which let me give you that level, is technically at 198.88. I don't like it. You guys know the deal. We like round numbers only up in the penthouse. We'll 75. Under 198.75 kicks off this as a double top, and you would trade for the equal low at 192. Here on the daily time frame chart, I can at least also illustrate the confluence with this as kind of a channel low. If you do something like that, I promise you, you can use the official Thinkorswim drawing tool. It is a parallel channel from your resistance trend line, right? Next up, last but not least, now we can say that for Netflix, what's going on with the streaming services? Great hold of 405.50. We were talking about that level multiple times on the pre-market shows. This did not produce a double top, getting back down underneath. Instead, we are above. This was not really a tradable outcome this morning, but nonetheless, your next big break, is up and over 419. Look at the range to the left. You don't have to be the first person in the door here. There's plenty of range to trade for. I mean, we're talking about 436.75 from 419. All right, so let an hourly uptrend develop in that range and start to chip away at the upside. You don't have to be the first one there. It's very reasonable that after a gap up and sort of this consolidation at the highs, you might need to continue to consolidate or close the gap even before making that upward rotation. So just be cautious about jumping into the long side on the first break of 419. There's enough range to go around, all right? Last but certainly not least, one additional trade idea for you, and then you are on your way. TTD, the trade desk, comes back into sight. What do we see out of the trade desk? What you'll notice is that this level is completely obsolete, but this one is not. This, of course, is the retest level, and what you're starting to see here is a 3-bar play in the upward direction. Don't worry about earnings for this week. This trade is valid into the end of this week. I think it's likely if the broad market can continue to get some support here, even if it hangs in there sideways, a break of this 3-bar play in the upward direction out of TTD retraces the thin structure from that red bar breakout and gives you the retest of the breakdown point here at 74 in the first place. So there's two methods to the madness. If you want to trade longs and the broad market is bullish, you could trade the long into 74 out of TTD. If you're skeptical of that and you're like, no way, Matt, you're crazy, man. This market's going to hell in a handbasket. And that's fine. You can have your opinion like that, but I would wait for the lower high to be set up against 74. So wait for the break, get here, and then when we start to see signs of inverted hammer, you see something like a 5 or 15-minute double top, whatever, 74 is your potential lower high. Then you will trade back in the downward direction. Be mindful of earnings because that situation does take some time to unfold. If we're interested in what happens into the end of this week, there's sort of your cup and handle. As long as we break out up and over that high, let me give you the number at 71 flat. 71 flat is the number. As long as we're over 71, looking for 74, 3 points of upside there, and this is in play as long as we hold that daily 200 SMA around 69.65. 69.65 would be the round number that I would be willing to bend for up here in the penthouse. So that's going to do it for today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Don't forget that we will be live. We're always live at 8:15 every single day that the market is open here on YouTube, and on Friday for the labor market report, we will have complimentary coffee and donuts. Make sure you swing by. With that said, I wish you a green trading week.